Hi, everyone. It's Grant Abbott here, and I've got Mr. Tim Munro from Change GPS and also Tony Anamoulis from Abbott-Family Lawyers.
Hi, Grant. Hi, everybody.
Senior partner. How are you, buddy?
I'm good, mate. In lockdown. It's just great.
Oh, God. I had to go to the dentist today and I had to go from Sunshine Coast to Margate. And by the time I got there, the guy said, "Oh, we're in phase 3. We're told we meant to call you and say that you're not, no one's allowed in here." So,
oh no,
very lucky to scrape in. But I got getting a huge bridge, and oh God, it was huge pain. But anyway, I'm tough. So there's a lot of stuff. I'm gonna go through quite a bit. I want to give you, and I think we've got a new advisor on board, or a new accountant on board, who's going to be working with Tony and myself, Alicia, and she's been doing a deep dive into NALI, so it's going to be interesting. So say hello to everyone. Alicia, if you want to give them your email address, so that if there's any technical issues, just ping her, Alicia at lightyeardocs.com.au. So she's a good little fountain of youth there. So I wanted to go through and have a really good look at this NALI stuff, and I've got some really it's going to blow you away, the case study, a little bit later on, and I think the commissioner has got themselves in a bit of a bind here, and of course on the strategy side, as is Tim, we're not here to simply regurgitate. We need to do a deep dive in the legislation and the Commissioner's rulings, which we'll do, but we're not here to simply toe the party line. The whole idea with anything is that when the Commissioner comes out with something, particularly the case studies, is to review them and then look at opportunities that come from there. One of the ones that I'm going to show you a little bit later on, and I saw it in the AFR today, but they really didn't, they missed the whole point. But a lot of the industry funds and also retail funds are going to be in a huge amount of strife with this NALI stuff, because a lot of them have discounted services in terms of management fees compared to what they would offer out into the marketplace. Likewise, they buy stocks at a discounted brokerage. So as soon as you come here, you'll see, it's not even Commissioner's guidelines, we're looking at the EM, explains exactly that, and I want to have a look at that it means all the income from those assets are essentially going to be NALI, as are the capital gains. And so we've got a new little barometer here, which is interesting. So it started off as non-arm's length income, and I want to look at that a bit later on. But now we're blowing into non-arm's length expenses, which then has a supposed impact on income. So then now this is where they're getting themselves in a bind, because they actually have to look at an expense and see, because it's pretty important. If it's tied to a capital asset, then it brings into account NALI income plus NALI capital gain. And it's a bit like the vaccination, that once you're NALI, you're always NALI'd, so you're branded forever. Even if you sell it 10, 15 years down the track, it's always going to be a NALI asset, which really, for that point of view, you should be taking that into account. So tax accountants, you need to be taking that into account in terms of your tax provisions, because even if it goes over to the pension side, it's still going to be NALI capital gain. So we've got to be very careful, but that's not us, that's the industry funds. For us then, it's, well, what about some of our other expenses? And in his guideline, which is it's gone through 2 iterations, and there's a lot around general expenses. So it's going to be interesting when we go down to show that general expenses probably aren't going to lead to that capital gain, that NALI capital gain, but it will lead to NALI income. So it's going to be quite an interesting scenario when we go down the track. And there's plenty of case studies there. I've got a really good couple of ideas, but I'm also, one thing when we go through today, I want to just get you to highlight in your mind that when we're dealing with this, particularly a self-managed super fund, where we're not allowed to take remuneration, which is interesting. So this is another bind. So it's got a double bind here. Yeah. We're not allowed to take remuneration unless we're a professional. So we can do that, but then if we do the professional, we have to do the full fee, or we'll discount it if it's allowed, like it's staff stuff. So then there's a whole lot of stuff going on, and the issue then is, are we doing things as and this is where I want us to go to, is are we doing things as an individual or are we doing it as a professional outside? And I think I've raised this many times before. So, for example, if I wrote a book on self-managed super funds, can I write that as an individual being Grant Abbott, the trustee, or is it Grant Abbott outside, or is it part of Lightyear Docs, or is it part of Abbott-Family? And I think that he's starting to go down there, and it's going to raise more questions, but also more opportunities. And I'm certainly not the font of all knowledge at all. I can guarantee that one. But we're all in this together, so we can all start to make decisions. This is, again, it's not about just some claptrap you'll find in a trade magazine. What we want to do is really rip in and do a deep dive. So how are you with it all, Mr. Tim, with all your NALI stuff?
Well, Grant, I've been waiting to be educated by you today. I've had a little look at it and trying to really get an idea of what do I need to do right now. I mean, for my own super fund, I mean,
Yep.
Look, I haven't been charging accounting fees. I've paid an external auditor, so that's great. What do I need to do now? So I've got a few ideas and things, but kind of waiting to hear your thoughts on this. And then, like you...
Yep, fantastic. So the first thing is, I want to lay your mind at rest. It's going to be quite simple because we've got until the 1st of July 2022. And this is an opportunity for Change GPS, Tim, to actually put in place procedures around dealing with entities that we provide services with. So that if we have a really good...
We'll have it ready to roll out, Grant.
Yeah, so if we get a nice, good manual, and you can imagine it, imagine how that is going to work out in industry and retail funds. It's going to be a disaster. But if we get a really good, succinct, coherent management policy, and definitely Change GPS will be right on the forefront of this, then we're going to be in a good position of meeting commissioners' needs. But anyway, let's go on and have a look at the history, the deep dive,
Brand,
and some case studies.
How does this sort of stuff get pushed through? And you've already said, like, there's so many angles that I haven't thought it through. Like, I know you and I've spoken about this many times, but seriously, the people in Treasury that advise the government, like, well, they just got rocks in their head, don't they?
Oh, absolutely. But then again, sometimes things being pushed through are good because it means that they stuff up and there's opportunities there. So unlike now in Queensland, that the poor businesses, and I feel really sorry for them, that we are going to go to this $750 a week supplement or whatever they're doing. I don't know who's paying or whatever, but they haven't even thought through the processes or systems or whatever. So mind you, Sydney's been in the doldrums as if Queensland is going to somehow escape it. So again, a lot of the stuff that when it's done on the fly, then what we have to do is then make sense of it. And you'll see when we go through, I mean, they originally stuffed up the first one. What I wanted to do though is really start off with this, and you've heard me say this before, and I would say there that when it comes down to this graph, it doesn't matter what the strategy is or the idea or the service or the pickup. So for example, if we have a look at the classic one is Afterpay. I mean, those guys were the innovators. Then they picked up a whole lot of early adopters in businesses, and now it's moved, they were the first movers, so they got the early majority, and, what do they get, a $39 billion payday, and, congrats to them. So for us, it's the same sort of thing as that, when we go through this, there's the laggards at the end. I just made I did an article for Benchmark Magazine, Self-Managed Super, saying that BDBNs are deadly. They're laggards because, when they were first introduced 25 years ago, they were only for industry and retail funds, but somehow we all adopted them for self-managed super funds. And my good mate, Dan Butler, has basically said that one of the commissioners come out and said, look, BDBN, the laws in section 59(1)A and also SysReg 617A don't and never applied to self-managed superannuation funds. So therefore, really, you've got to have a look at what is embedded in the trustee. So to still have that nomenclature, and when you've got lawyers out there and the no-win, no-fee lawyers these days, in fact, in the article, I've got a direct quote from Dan saying that he would challenge every BDBN. So obviously they're not secure, and I would put them down at that laggard element, so that if you're using BDBNs, for me, and have a look at the article. If you want to get the article, just contact our team at Lightyear Docs. More than happy to shoot you off the article as to why DBNs are dangerous, particularly for our clients, and more importantly, how the concept I developed around about 12 years ago, and have now really enshrined and built and strengthened and made a lot more secure. The SMSF will is really the place to be. But I don't want to just focus in on that. I want to focus this on a mentality. So, for example, many of you are using Lightyear Docs, many of you using Change GPS, and you're that early adoption or that visionary phase. You see with me, for example, SMSFs are really well and truly in that late majority phase. We're now going to family super funds, which probably in that early adoption phase, if there's going to be a shift, and I'll look at that also in that article as well. But essentially, it's a mindset for us. And that was a pretty big mindset, because a lot of people, if you're in there right from the get-go, then you can look for an opportunity, take advantage of the opportunity, and all the money's to be made in the early adopters. And I'm going to cover that issue that Tim created. We've got a couple of questions here that I'll look at. Maybe Tony, if you could address the questions in the chat line. I'll always look at the Q&As. So we've got, how do you determine what is a fair price for the accounting fees when you're only dealing with one fund and the fund are under 100K? So let's have a look at that a little bit later on, because there are some determinations in there. Is this NALI for all business or SMSF? No, sorry, Daisy, it's not for all business. It's only in relation to superannuation funds. So anything that's a superannuation fund, it's covered in section 295-550 of the Income Tax Assessment Act 1997, which is just simply the taxation of superannuation funds, and self-managed is obviously a subset of that. John Stitt, client group trust charges management fees for managing their SMSF owned commercial properties rented to third parties. Is that NALI? Again, we'll have a look at that when we come down, but they have to obviously charge management fees, otherwise it would be NALI. But then that one, it's potentially, if it's property management fees, there's a good case study on it, that it would be just NALI income, not NALI capital gain. And remember, we don't want to get both, because if we get both, it's an issue. But I'd harken back to what Tim's saying. It's a pretty crazy scenario. Now, the reason I put this up is because way back in 2007, the government enacted laws that essentially, this was the days of the simple super, that allowed SMSFs to borrow to acquire shares, property, and, well, basically any asset. So it's pretty laissez-faire, very easy to use rules in those days. None of that single acquirable asset stuff. And essentially you could borrow. That meant there was a lot of investment banks. I think Royal Bank of Scotland did like these self-funding share portfolios you could use. There's obviously property there as well. Westpac, NAB were in there. ANZ only went in there because they didn't want to lose market share. And look, I did sessions and advised all of these guys. In 2010, it went from 67.4A, which was the more relaxed attitude, and things change over time, obviously, to section 67A and 67B. Now, what happened is, and you have to think about it, remember 2007, the lead up to 2007, we were able to put in $1 million of transitional contributions. But after that, there were caps after that. They were a lot more generous than they are today, obviously. But contributions were strictly limited. So, where we had a look at before, we could have put whatever contribution we wanted to as a non-concessional, but then we were subject to RBLs. They dropped the reasonable benefit limits off, which is essentially just an RBL is much the same as the younger ones, the T-bar that we've got for pensions at this current point in time. But what happened there is that by opening those gates, there was that little level of innovation, which we came around here, that people came up and said, well, hold on, what happens if I did a nil interest loan? So, for example, I had a $50 million property. I decided to transfer it into the superannuation fund. A little bit of it's going to be contribution, but the rest of it's going to be a nil interest related party loan. Now, at that stage, when we had a look at it, the Commissioner came out in a number of forums, National Tax Liaison Group, superannuation forums, given a couple of rulings that, in essence, because when we have a look at superannuation, because a nil interest loan is actually going to benefit the members of the fund, enhance their benefits, effectively from that perspective, it wasn't non-arm's length. And when I mean that, there's cis arm's length, or cis arm's length, and then there's tax arm's length. So cis arm's length generally works in the reverse, and that what it does is it says, look, you can't give someone else a better deal than what you'd be entitled to. For example, if we had a property manager looking after, and look, this is coming down the track now. If we've got a property manager who's a related party who's looking after one of our properties, and they normally charge 10%. If we charge 15%, then effectively that extra 5% would be non-arm's length in terms of the CIS Act. And obviously then we've got compliance issues, and there's an on-the-spot fine as well. Whereas the reverse, if the market rate's 10 and we drop it down to 5, then everyone in the super fund, the members, are happy days, because they're paying less expense, which means that there's more rental income going in, which means it's increasing the members' benefits. So everyone's quite happy about that. And really, they probably could have easily said, look, that extra 5% that's going in could have been treated as perhaps a contribution, but they target it through the non-arm's length income provisions. But essentially, it went along for a while. And look, I've seen some properties being transferred in with, $40 or $50 million of limited recourse borrowings at nil interest rates. So the tax office focused heavily on the CIS side, but they were getting boxed in. So suddenly they came up with a thesis that this was non-arm's length income. The problem about that is that when they did that, the old law focused in on income, whereas this was a reduction in expenses. So it's very tortuous. I don't want to go into it because technically it was basically wrong. And essentially what they did, though, is by coming in and saying, look, we're looking at this, it's not arm's length income. They produced a really torturous treatise saying that it was net income of the holding trust, blah, 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 anyway. And as a consequence of that, that really put that nil interest in a spin and virtually stopped it overnight, which is essentially what they wanted. Then they came out in 2016, and for those of you who had a look at it, they did Practice Compliance Guideline 2016/5, which looked at the issue, looked at what a reasonable person would do. So when we had a look at what is arm's length and what is non-arm's length, and I'll have a look at that in terms of what accounting fees to charge. But essentially they said, well, look, in terms of borrowing, we've got property up here, and then we've got listed shares. So obviously not private unit trusts or private company shares or 1322Cs. So what we're going to do is here's our rates, our guidelines. I think the current environment's around about 4.7 or 4.82 or thereabouts. But you've got, if it's a property, it's a 15-year property. You have to pay P&I over that period. There has to be a mortgage deed. Doesn't need to be a guarantee. So you've got to have a look at all that. So they're still being enshrined in the law. Now, what still the problem was that as we went down, it was still, I believe that they knew inside that if it was going to be challenged, it would be knocked out. So then they came up with the new NALI, and I'm going to take you through that, and also we'll have a look at the EM. So the expense, the main issue is, look, we're pretty comfortable with the non-arm's length income side of the equation. But now we've got to have a look at the expense side of the equation. So, for example, if we had an office in our super fund, and then we leased it back to our business, if it was running through a trading company, and then the market value rent was $5,000 per month, but we charge $7,500 a month, then that extra $2,500 would obviously be NALI income. So that's pretty easy to understand. But again, it comes on that expense side, which really is a brand new thing that's come up. Although they try to explain it, that's been there forever, it hasn't. And quite clearly, when you look at the EM, it's not. So the expense side is the big issue. And what we need to do is have a look in our own mind how we're doing it. But really importantly for all of us is what's the process and system? I said the process and system, we've still got plenty of time there until 1st of July 2022, because the Commission said we're not doing any compliance action until that time. So there's plenty of time for us, but it's not so much just for the accountants and all that. We need to have a look at property developers, people buying properties inside the fund, a whole lot of other things that really will start to crop up. So what I want to do is have a look at a little case study here, which I think is quite interesting. It's hardcore, and I only just wrote the case study, so I don't know the answer, but I want to come back and look at it. So what I want to do is look at the case study. We'll then go and have a look at the law, the guidelines, and then we'll come back with a potential solution on if there is one. So we've got a property developer finds a site. So, property developers are out there getting sites, day in, day out, and decides to acquire a particular property in the SMSF. So the SMSF funds the land. So that's all okay. So we're not looking at any LRBAs. This is a pure finance one, directly in the SMSF. There's no JVs or anything. So obviously with all of this stuff, any JV you do, you've got to be right on the money. Otherwise you're going to be NALI income, NALI capital gain. So anyway, the property developer finds a site. So then the SMSF buys the site there. So they buy the property. And instead of the development company. So the first question is, would that be NALI? Well, if they're dealing with a third party, then ostensibly it's not going to be NALI. But the issue is, has the work, so listen to this, has the work the property developer done, is that as an individual or is it as a trustee? Is it an individual or is it in their own right? For example, if I went to a property developer and said, I want you to find a site for me that's going to be a cracker, then obviously I'm going to pay them a commission or a fee for that. So again, I would say potentially it may well be NALI, both income and also capital gain side. I'm not saying it definitely is, but I'm just saying is we need to stretch our mind and start to think of where this starts to apply. And again, this isn't just about SMSF. This is going to be exactly the same for the large retail and industry funds. In fact, probably more so. Okay, so that's the first one. The second one, we're going to come back, and development company provides a construction at cost plus 10% build, which is their standard for the development company. So, if anyone comes and says, I want to do a bit of building, it's going to be cost plus 10%. So that's fine. So is there an issue with NALI in that one? But they do a no deposit. So they'll do the build. There's no progress payments for the build, and then the super fund just has to pay at the end. So the issue there is typically you'd be paying, for most of you who've gone through developing properties or building properties, you have to put a deposit and then there's ongoing payments going through. So for me, is that NALI? And again, is it NALI or is it NALI income, NALI capital gain? Now, mind you, in this one, there may not be any capital gain, because if it's an SMSF, if that property is then going to be rented, does that mean that NALI rental income is NALI? The rental income is NALI. And does it then mean that's now a NALI asset? So now, here's an interesting one. During the dev phase, the developers offered a $400,000 premium because things are pretty hot. And so they accepted as trustees of the fund. So they go into a contract in order to, which is an interesting way to do it from a legal perspective, that they haven't completed the last one, but they're actually selling this off. So if they sold it now, it'd be like an equitable right. But let's say they enter into a contract. So it's it's a $400,000 premium. So suddenly the property is worth an additional $400,000. So the question is was that NALI in that instance? Or more importantly, is that $400,000, is that extra going to be NALI because it's above market value? We'll come back and have a look at that one. Now, the trustee of the SMSF sells a property prior to conveyance to save stamps. So I think that's wrong anyway, because I've already got the land anyway, and books a $500,000 capital gain in the pension side of the fund. So happy days, no tax payable, everyone's happy there. But then the question, is that NALI, or is there any other issues that we have to look at? For example, Part 4A or issues like that. So I'll come back and wheel around onto that one. But I just wanted to highlight it there for you. So I got from Brad Smith, how do unit trusts owned by SMSF stands in respect to NALI? Okay, we'll have a look at that one, Brad, because the NALI stuff actually does go up into the unit trust, and we have to look at the way it comes down as well. So from Debbie Potts, per LCR 2021/2, which we'll look at, in line with this, then if we as a firm have all of the discounts, no fee across the board, then the ruling does not capture our SMSFs. That's true. And the same with the reciprocal with a financial planner. So again, you're going to have some pretty good discounts as well. So let's go and have a look at what we've got. So I'm going to come back. I'm just going to bounce out of here and we'll go and have a look at, for those of you who know me, we always start off and we have a look at what the law says. So I'm just going to go in here. This is being recorded, so it'll be up and running later on this afternoon. So this is the new super tax that we're looking at, so section 295-550. I'll just take it to the EM first. So this is when this was really introduced. So this dealt with the other one. So you can see paragraph 120 of the EM. Similarly, the application of paragraphs 295-551B and 5B may be ambiguous. So this is where it was non-arm's length income, where expenses incurred by a superannuation entity in respect of an asset that are not on arm's length terms, but the amount of ordinary or statutory income from the arrangement is the same as might be expected of being dealing at arm's length. This may be the case, for example, where real property is acquired under LRBA, where the rent derived under the scheme is at market rates, but the interest paid on the loan is not. So again, it was a very tortuous, and again, if you see in the laws and explanatory memorandums that they're saying it's ambiguous, it means that if it went to court, it's very unlikely that it would not apply. So that's the EM. So when we have a look now, we've got, it's not a difficult section. So we've got medium non-arm's length income. And the problem is, because it's not so difficult, it then means that we need to have a whole lot of interpretation from the commissioner. And I can see guidelines and rulings and all of that stuff going for years. So we've got an amount of ordinary income or statutory income is non-arm's length income. And ordinary income, for example, is just rent, things that are income under ordinary concepts. And statutory income, for example, is net capital gains would be included there. If, as a result of a scheme, the parties to which we're not dealing with each other at arm's length in relation to the scheme, so there has to be a scheme, one or more of the following applies. The amount of the income is more than the amount that the entity might have been expected to derive if those parties had been dealing with each other at arm's length in relation to scheme. So that's the classic one. So that's the one that was there before, the 295-550A, which we just saw in the EM, is saying, well, hold on, that really, in fact, they've changed the B, but essentially that really doesn't cover us there. Now, when we have a look here, B, in gaining or producing the income, the entity incurs a loss, outgoing or expense of an amount that is less than the amount of a loss, outgoing expense that the entity might have been expected to incur if those parties have been dealing with each other at arm's length. So now we're actually starting to bring in this NALI expenses. Or in gaining or producing the income, so that's important because we've got a link there, in gaining or producing the income. Now, the silly thing about it is what they've got here, and look, I don't want to be a bit of a knobhead on this one, but see, in gaining or producing the income, they're talking about, if you have a look at all the laws and ATO rulings, income is just income under ordinary concepts, so they don't actually talk about capital gains. But again, going back to what Tim said, is that they deliver this really quickly, and they don't think through the logic of it. Anyway, in gaining or producing income, the entity does not incur a loss, outgoing, or expenditure. The entity might have been expected to occur if those parties have been dealing arm's length. So that's, for example, a nil interest loan. So this is discounted loans. This is nil interest. So this is, for example, we're not charging bookkeeping fees, or we're doing it at a discount. So this subsection does not apply to amount to which subsection 2 applies, or amount derived by the entity. So that's dividends and stuff like that. We then go down, Brad, there's quite a lot here as well. So other income, and I'm not going to have time to go into this, I just want to stick at a high level. Other income derived by the entity is a beneficiary of a trust through holding a fixed entitlement. So that's because if we have a look, income derived by the entity is a beneficiary of trust other than because of a fixed entitlement is non-arm's length income. So that's discretionary trust, or any distributions obviously automatically NALI income. In fact, yeah, we'll go into that. I know Peter Mamara Stewart's got a really good ruling out on that one. Other income derived by the entity is a beneficiary of a trust through holding a fixed entitlement to the income of the trust is non-arm's length income of the entity if, as a result of the scheme, the parties to which we're not dealing with each other are arm's length in relation to the scheme. Again, it's the same as the income, so we're doing the same thing. In inquiring the entitlement, so that's the buying the units, or in gaining or producing the income, so that's obviously the distribution, the entity incurs a loss outgoing. So the entity is obviously the superannuation fund. In acquiring the entitlement or gaining and producing, the entity incurs a loss outgoing expenditure of an amount that is less than the amount of a loss outgoing or expenditure the entity might have been expected to incur if those parties have been dealing with each other at arm's length in relation to the scheme. In acquiring the entitlement or in gaining or producing income, the entity does not incur a loss or blah, blah, blah. So again, it doesn't seem to go up in, and that makes sense. It doesn't go up into the trust and look at that. And the reason that is that the SIS Act only has power to deal with superannuation funds. So what it does is it focuses in on its entitlement in terms of that, that unit trust itself. And we've got a whole lot of stuff there. So if we go down to the explanatory memorandum, and I'll come down and have a look, there's a couple of interesting little statements here. So we've got the old law and the new law. So 126, a new provision is added to ensure that a superannuation entity's non-arm's length income includes income where the expenditure incurred in gaining and producing it was not an arm's length. This includes where no expense was incurred, as we saw before. So I want to take you to this one, which is pretty obvious. So an SMSF acquired a commercial property from the third party at its market value of $1 million on 1st of July 2015. The SMSF, now this is important because this is the explanatory memorandum, it's not the commissioners. So this is, if you have a look at it, commissioners' guidelines are here, EM and the laws are actually up here, cases are up there with the EM and the laws, in fact, probably just a little bit higher if you ask me. The SMSF derives rental income $1,500 per week from the property or $78,000 per annum. The SMSF financed the purchase of the property under LRBA from a related party on terms consistent with Section 67A of the SIS Act. The LRBA was entered into on terms included no interest, no repayments till the end of the 25-year and borrowing the full purchase price, 100% gearing. The SMSF was in a financial position to enter into an LRBA on commercial terms with an interest rate of approximately 5.8%. So this is the important. The amendments in this bill make it clear that as the SMSF has not incurred expenses that it might have been expected to occur in the arm's length dealing and deriving the rental income, that income would be NALI. The income, less deductions, will form part of the SMSF's non-arm's length component, will be taxed at the highest marginal tax rate, which was quite interesting. Now, when we have a look at that one, the question there is that's probably also going to be NALI capital, and you can tell that from the next one. So expenses relating to super entity as a beneficiary. A retail super fund acquires units in the unit trust but pays a lower amount for the units than stated in the promotional material for the unit trust due to a scheme the fund has entered into with a broker. So this is stock standard whenever you have a look at an IPO or whatever. These large retail industry funds obviously get discount off the brokerage. So, you know, here's an interesting one for them. In acquiring the entitlement to a share of the unit trust's earnings, the retail super fund did not incur expenditure might have been expected to incur if dealing at arm's length of the broker and purchasing units. Now, here's an interesting. So this is the double whammy. So the income derived from the units would have been the same whether or not they were acquired under an arm's length transaction, but it was obviously a discount, so we get a brokerage. The amount earned is non-arm's length income of the retail super fund. So that means going on down the track, all income from those units are going to be non-arm's length income. Likewise, when we have a look here, any net capital gain made on disposal units may also be NALI due to the amendments in subsection 295 551. So when we have a look at that, I also wanted to bring into account here, we talk about non-arm's length capital expenditure. Range of transactions may be on arm's length terms. And again, I'm not necessarily going to focus in on what the Commissioner says, because again, this is probably a higher authority. It can be difficult to determine exact price that is non-arm's length. An arm's length price may be accepted to fall within a range of commercial prices. For example, loans may be available at different interest rates based on a range of factors. Accordingly, for example, SMSF may be able to apply an acceptable commercial rate of interest to a loan within a band of rates available to it on an arm's length basis. So if we went out and did an LRBA now, but it's going to be a related party, then we could go to Liberty, La Trobe, find out what the normal rates are. And if it's 80% LVR, with a 4.5% interest rate payable over a 25-year period with the first 10 years interest only, then we could obviously apply that one. Transactions that are on arm's length terms, for example, borrowing arrangements financed by banks and other commercial lenders or that meet the safe harbour, are not impacted by these amendments. So again, what they're doing is they're just basically saying if you're borrowing from a bank, it's not going to be impacted, but a related party will be the case. So that's the EM. What I want to do is we'll have a look at the guidelines. This is the first one that came out, I think, if we have a look at it. Let me just move my little face over here. Actually, this is the first one that came out. So PCG 2020/5. So that came out and sort of gave out the first shot across the bow in terms of the Commissioner as to what arm's length income would do. But notice the transitional, and this is always the case here. So that, let me just go up a little bit. The ATO will not allocate compliance resources to determine whether the NALI provisions apply to a complying fund for the 19, 20, 21 and 22 income years where the fund incurred non-arm's length expenditure as described in paragraphs 9 to 12 of LCR 2019/3 of a general nature. So where it's a general expense, what they're saying is, look, I'm not sure they're making up on the fly, but I'm just saying is they've come up with their idea of their own general expense. So then we're going to have to look down 30 June 2022, which is quite conciliatory. So what we want to do now is we're going to look at the law companion ruling for the next 10 to 15 minutes, and then we'll back on a couple of things. This is the one that was just recently released and has a whole lot of people up at arms. I'll have this and the prior one and the EM. I'll put that all in the material there for you. Again, for those of you here, make sure that you've registered and let our guys know, because essentially, well, obviously we'll know anyway, because essentially what will happen from there is that you'll get from FASEA, it's one technical point. For CPE, so for tax practitioners or tax agent, it's one CPE, and for the SMSF Association, it's 1 hour as well. So non-arm's length income, so this is just focused solely on that NALI. So when we look at NALI, it's NALE. So we're looking at non-arm's length expenses. So you can see we've got a bit of a, quite a sizable ruling. It goes in further, talks about the prior stuff. So this is the important, the non-arm's length component of an income year is the amount of the complying super fund non-arm's length income less any deduction to the extent that's trivial. To the extent the ordinary and statutory income of complying fund is NALI, the income is not exempt current pension income. So remember, I talked about that a little bit later on. So we'll just go down there, and again, I'm just highlighting it all for you. There's a lot of stuff here. So in applying paragraphs 295, 551B and C, non-arm's length expenditure, it's necessary to identify the relevant scheme under which the parties to the scheme would were not dealing with each other at arm's length. A scheme is defined as any arrangement, any scheme, proposal, action. So obviously, if you're providing stuff for a bookkeeper or you're doing the SMSF administration, you're going to be right involved there. 17, in identifying whether complying super fund has incurred NALI, there must be, and this is important, there must be a sufficient nexus between the non-arm's length expenditure and the relevant ordinary or statutory income. And that's the big bind that they've got. If there's no nexus, then it can't be NALI income. And remember, we saw that in the thing that said, look, you got to have in bringing up this income, this ordinary or statutory income, but remember, it just said income. We have to look at that expense has to be related to it. So that is, the expenditure must have been incurred in gaining or producing the relevant income. We saw that in the laws, or acquiring the relevant entitlement. While guidance can be, this is for the tax guys, can be obtained from jurisprudence concerning the application of section 8.1 to determine whether there's sufficient nexus between NALI and the relevant income, the non-arm's length expenditure does not have to be deductible under section 8.1. So the non-arm's length expenditure may be of a revenue or capital nature. So they don't really care because, again, it's not deductible. They're actually looking at how that income is going to be taxed. So it's the taxation of the income, not the deduction. 18, non-arm's length expenditure incurred to acquire an asset, including associated financing costs, will have a sufficient nexus to all ordinary or statutory income derived by the complying super fund. So in that instance, remember we had a look at the NALI for the broker who discounted the IPO. Effectively, that means that you can show that there's a discount there to acquire that asset, and as a consequence there, we've got NALI income, NALI capital gain. So that's the worst of all worlds as well. As you can see there, this includes any capital gain derived on the disposal of that particular asset. Now, in some instances, and this is where we need to focus in on, in some instances, the non-arm's length expenditure will have a sufficient nexus to all of the ordinary or statutory income derived with the fund. So here's the word, all of the ordinary or statutory income. Got that one? All of the ordinary or statutory income. So we move beyond the capital to all of the ordinary. For example, a fund, and this has been through a whole lot of submissions. I must admit, I didn't make a submission on this. For example, a fund may incur expenditure that does not specifically relate to a particular amount being derived by the fund, but still has a sufficient nexus more generally to all income. And remember, there's a difference because if we look at an asset, then it's the income from that asset that flows out and the capital gain. So we follow that one. So that's our double bind. This bind is different because if we're tagged, all income is NALI. So the whole fund is NALI. So auditors, you're gonna have a lot of fun with this one. So I think it's going beyond the pale, but it's what the commissioner's got. So to all income derived with the fund to be deductible, so such as actuarial costs, except those incurred in complying with or managing the fund's income tax affairs and obligations. So if an actuary goes in and puts their costs at a deduction, which are already deductible, accountancy fees, except those incurred in complying with or managing the fund's income tax affairs and obligations, audit fees, costs of complying with regulatory provisions, trustee fee and premium under indemnity insurance policy, costs in connection with the calculation and payment of benefits to members, for example, interest on money borrowed to secure temporary finance, investment advisor fees and costs in providing pre-retirement, other administrative costs incurred in managing the fund. So, for example, if we did a BDBN there, would that be included in that? Would that be included if we did it for free? We'll have a look at that a little bit down the track. I would say probably not, because we're doing a BDBN in relation to the member themselves rather than the trustee. But it's not with that doesn't mean it's not without arguing. So 20, where the fund incurs non-arm's length expenditure of the nature outlined in paragraph 19. So you've seen all that one. The nexus between the expenditure and all of the income derived by the fund is sufficient for all the income to be NALI. Bang, 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 bang. Now, if that doesn't create a warning light to you, then I don't know what is. So that is scary. So all of these things here, actuarial, accounting, audit, costs of complying with that, we have to look at all of those costs and work out whether they're NALI. So we want to go down, we want to break it down a little bit later on that, you know, are you doing as a trustee or are you doing as a professional? So we should have that down pat. So, so look, during the, well, this is pretty obvious. During the income year, Armin holds a commercial property with a market value of 800. During the income year, he sells commercial property to himself, acting as trustee of the fund for $200,000. The SMSF leases the property to third party. For the purpose of 295-551, the scheme involves SMSF acquiring the property for amounts less than market value. Hello, there's sufficient there. Look, that's a joke really, to have a looking at it here. This is an interesting one. Example 2, non-arm's length expenditure has a nexus to all income of the fund. It's NALI. For the 2021 income year, Mikasa Yosukasa, as trustee of a SMSF, engages an accounting firm where she is partner to provide accounting services for the fund. The accounting service includes services other than those relating to complying with or managing the SMSF's income tax affairs and obligations. The accounting firm does not charge the SMSF for those services as a result of non-arm's length dealings between the parties, not as part of a discount policy, which Debbie raised a little bit later on before. For the purpose of section 295-551, the scheme involves the SMSF acquiring the accounting service under a NALI. The non-arm's length expenditure, being a nil amount, remember that's that subsection C, has a sufficient nexus with all, let me just go there, all of the ordinary statutory income derived by the NALI. As such, all of the SMSF income is NALI. Can you believe that? Isn't that classic? So you mightn't charge, what, a couple of grand for doing the accounting and admin, which you normally charge, but suddenly all of your income is going to be NALI. Anyway, subsection 295 would cease to apply if, now this is the important, if the arrangement charges for 2021-22 income year, so the SMSF incurs expenditure for the accounting service provided by the accounting firm of an amount that would have been expected to be incurred with the parties dealing with each other at arm's length. And again, if you're actually, let's go and have a look at it a little bit later on. Purchase of an asset under arm's length, we sort of talked about that. Purchase less than market value, NALI, that's pretty obvious. There's a good one here, purchase limited recourse, again, the same sort of stuff. Part purchase, part in specie, but they paid everything full value. So the discount, there was no discount, it was treated as an in specie contribution. So that was not NALI. The funny thing is, to what extent is NALI? Okay, now this is where things get, for me, this is where the real rubber hits the road. So I think the rest we can do, you know, again, I'm shocked that the general expenses actually lead to all of income. But anyway, in the context of SMSFs, it may be necessary for an individual to ascertain whether they're performing an activity as a trustee of the super fund or whether they are acting in a different capacity. So that is the, you know, this is now, to me, this is opportunity land. So what I'm doing is, what they're saying is, what hat have you got on when you're dealing with your own SMSF? So let's go through. And this is where we get in a bit of a bind here. So an SMSF is a super fund that satisfies all conditions in A and B. The statutory scheme requires a member of SMSF to be the trustee of the fund or a director body corporate trustee, unless there's an APRA. This also prevents the trustee or a director of the body corporate, there's a trustee of an SMSF, from receiving remuneration for any duties performed by the trustee or director. So that's interesting. So how's this one going to work out? However, B1 and B2 provides exceptions to paragraph 1F and G and 2C and D, such that a trustee or director or corporate trustee can receive remuneration for duties or services performed by them if they perform the duties or services other than in their capacity as trustee or director of a body corporate that's a trustee, are appropriately qualified and hold the necessary license to perform the duties or services. Perform the duties or services in the ordinary course of a business carried on by them, performing similar duties or service for the public, and receive remuneration that is no more favourable to them than that which is reasonably to expect would apply if they're dealing with the relevant other party. So, for example, let's have a good look at my good mate Tony Anamoulis there, who's a lawyer, licensed lawyer. You know, we've got he's not only has got a practicing certificate all throughout Australia, but also New Zealand. Now, Tony does his accounts for his SMSF, on his, QuickBooks, does all of the stuff, prepares it all, and then sends it off to Tim. And Tim does a cheaper version of doing those accounts, because Tony's done most of the work, and then it goes off to audit. So there, one is the first thing is Tony can't charge the fund for doing all that accounting and bookkeeping, because it doesn't fit in here. Because you understand what would happen? Suddenly, if they didn't have this, then people will be taking money out as of their own right, which is essentially what the Commission is saying is, if you're doing it as you're an accountant, you can have access to your money in super if you want, which is quite an interesting scenario, because it sort of goes counterproductive, because then you'd have to bring in the sole purpose tax. You don't want to take too much out, because otherwise you're providing yourself with a member benefit. So we've got all this spaghetti that's all going on. Now, given the statutory restrictions to prevent, so we're paragraph 42, given the statutory restrictions to prevent a trustee or director of a corporate trustee from receiving remuneration, paragraphs 295, 1B and C, which we looked at, will not be enlivened. I must admit, I've never seen, why don't they just say will not be utilised due to the trustee or director not charging for the service performed in relation to the fund when acting in trustee capacity. For example, the non-arm's length expenditure provision will not apply where a trustee acting in that capacity performs bookkeeping or accounting services for the fund for no remuneration. So there you go, Tony, you're sweet on that one. So therefore it's not NALI. And you can see if you get it wrong, it's the whole thing is subject to income. Whereas if Tony did an upgrade of his trustee and didn't charge for it, then bang, that's NALI. Does that make sense? That's just crazy. Of course, then he has to work out what market.
Right, what did you say just then?
Yeah, woke him up there. So if he actually upgraded his deed and didn't charge for it, then essentially because he's licensed to upgrade the deeds, etc., then effectively, from that perspective, that would mean all his income would be NALI income. So obviously, right, It would just charge whatever the market value rate of the deed is. And just as an aside, I'm probably going to go about 10 minutes over. I hope you don't mind if that's okay. But what I'm seeing and what I'm feeling anyway, since probably 2015, I remember calling it at that time, 2015, saying, look, this is the best we're ever going to get in SMSFs. The Commissioner is taking a harder line on SMSFs. Because look at all this stuff that's gone out over the last year or two. There's budgets are running huge deficits. They can't increase the GST, or very unlikely they'll increase the GST. Up here in Queensland and New South Wales, the deficits are going to run by continuing to pay $750 a week for people who've been, lost quite a significant amount of their income as a consequence of the lockdowns. When we have a look at that, we have to look for hollow logs, because GST they're not going to increase, because otherwise that'll have a recessionary impact on the economy, and that'll be the last thing they want. So when we have a look, and they're not going to increase taxes because, again, businesses are getting smashed as it is. So we have to look for the hollow logs, and the hollow logs essentially going to be superannuation. So we're starting to see the Commissioner getting a lot tougher. Remember that investment strategy ruling on diversification? That was right out of the bat. And the one he did in February 2020, which was a bona fide investment strategy that all the members' retirement objectives must be included in the investment strategy. Otherwise, it's a breach of the rules. Then 52B2F. Then we're in a pretty big position. Now we've got this, and remember we've got that auditor independence again. So we're going to find there's a lot more bashing around the edges on this stuff to make sure that we're compliant. So when we have a look here, so where do I go? Enliven due to the trustee, for example, again, 43, however, when the trustee or director of corporate trustee operates in another capacity and either does not receive remuneration for those services or receives remuneration in accordance with exceptions, may apply. The trustee or director of a corporate trustee of an SMSF will be required to perform particular actions in order to satisfy obligations. So that's obviously meeting the statute, any fiduciary obligations imposed by the law, any duties or obligation imposed under the trustee, absolutely. The trustee of the SMSF may also provide the trustee or director of the corporate trustee the power to perform certain actions. So the question would be interesting if we wrote into the trustee that the trustee must perform these, what would happen? 46, an individual's business, profession, life experience or employment may result in the individual having skills and knowledge that can assist the individual perform their duties in their capacity as trustee or as director of the corporate trustee of an SMSF. Utilising such skills and knowledge of itself does not indicate that the individual is not acting in their capacity as trustee or as a director of a corporate trustee. For example, a financial advisor who is a trustee of an SMSF can utilise their skills, hopefully, and knowledge in deciding the investment strategy of their SMSF in their capacity as trustee. In the context of applying these, it's appropriate to presume that an individual is acting in their capacity as trustee or director of a corporate trustee, where the actions are consistent with a duty, obligation or power referred to in paragraph 44. That's the compliance and also the trustee. So I can see what we're going to be doing is we're actually going to be putting further clauses within a trustee to bolster it up so that if there is an accountant or financial planner, that if they can bring those skills to bear, then they are fitting within that paragraph 44. Anyway, unless there are factors that suggest a contrary conclusion, factors indicate that the individual performing the activities in their individual capacity and not in their capacity as trustee include the individual charges the compliant fund for performing the services. So again, that seems to go counter against this. So he's actually saying you should be charging if it's the trustee, obviously. However, there can be circumstances where the individual can be acting in their individual capacity even though they do not charge. The individual, this is an interesting one, use the equipment and other assets of their business or equipment and other assets used in their professional employment in a material manner. However, this is important, however, minor, infrequent or regular use of equipment or assets will not of itself indicate the individual is acting in their individual capacity. For example, in the absence of any other factor indicating otherwise, minor, infrequent or irregular use of a business computer at the office by an individual would not of itself indicate the individual is acting in their individual capacity. So that's not a bad one. The individual performs the activities pursuant to a license and a qualification relating to their business or their professional employment. That is, the activity can only be performed due to the individual or business holding the relevant license. So that's, for example, that's where you might go to the planning, although you will find, and I think they missed out on that one, is that embedded within the Corporations Act, there's a specific exemption for trustees of self-managed superannuation funds. So it's an interesting one for the planners that when you're doing this, as if you're acting as trustee, you're not required to be licensed. The activities covered by insurance policy. Okay, so where a trustee or director of a compliant fund performs services other than these capacities, for example, an individual capacity to compliant fund for remuneration, the non-arm's length provisions will apply where the remuneration has occurred by the fund in gaining or producing ordinary or statutory income. The remuneration is non-arm's length. The non-arm's length expenditure provisions will also apply in these situations where no remuneration is provided. For example, the non-arm's length expenditure provisions will apply where a trustee, being an accountant by profession, contracts the bookkeeping or accounting service of the accounting firm which charges non-arm's length rates. Whereas if they did it themselves and didn't charge a fee, it seems as though that's okay. But as soon as they charge it over, although you'll see a little bit later, it also talks about here, which was raised. Sorry, my dogs are so excited about some of these things. They're really giving the commissioner a good bark up. So 51, a complying super fund might enter into arrangements to result in it receiving discounted prices. Such arrangements will still be on arm's length terms where they're consistent with normal commercial practices, such as an individual acting in capacity as trustee being entitled to discount under a discount policy where the same discounts provided to all employees. So again, as Debbie said, just follow 51 if you want to do it. Either do it yourself or get it done. So let's have a look at a couple of examples. Then I want to go right to the end. Then we'll come and do, I'll do some questions and we'll just finish off. Okay, Leonie is the trustee of an SMSF of which she is the sole member. She is a chartered accountant, registered tax agent who's employed in an accounting and tax agent business. Leonie, in her capacity as trustee, prepares the accounts and annual return for the SMSF. She does not use the equipment or assets of her employer, nor does she lodge the annual return using a tax agent registration. As she performs these duties or services as trustee of a fund, she does not charge the SMSF for this work. The non-arm's length expenditure provisions do not apply as the duties or services performed by Leone are in her capacity as trustee rather than under an arrangement in which the parties are dealing with one another or on a non-arm's length basis. Okay, example 7, SMSF trustee carrying out duties trustee capacity. Levi is the trustee of the SMSF, which is the sole member. He's also a financial advisor, director of Levi & Co Financial Services. Levi operates a business of Levi & Co Financial Services from commercial office and on regular occasions from his home. In fact, most of us probably do it from home now. At home, Levi uses the computer and office equipment supplied by and paid for by the business. When at home, but not while working billing clients, Levi undertakes a bookwork and occasionally makes online investments for his SMSF using computer and office equipment supplied by the business. Levi performs these activities as a trustee of his SMSF, does not charge the SMSF for this work. Levi's use of the computer and office equipment at home is minor incidental. So that's not too bad. You'll see here, I'm not going to have time to go through, but we've got a property management one there. And obviously they do it at a discount, or if she does it for free. So therefore it's the double NALI there as well. SMSF trustee carrying out individual duties. Again, there's a property management there. Have a look through that one. Beneficiary of a trust. Example 12, SMSF incurs non-arm's expenditure in acquiring a fixed entitlement. So during the 2016-17 incoming year, Scott entered into a non-commercial LRBA with himself and his capacity to purchase units valued at 50,000, 100% LRBA anyway. So that's outside the rules. So that's fine. Now I wanted to just go down here and finish off here. So this is the important one. So we obviously need to do a bit more of a deep dive, and we now start to focus in on, the Commission's given us a bit of an out there that, if we're doing it as our individual capacity, we're okay. Even if we log into our computers and do it in a minor way, we're okay. For a lot of our clients, though, property development, a lot of those ones I talked about, that's where we're going to have some major issues around that NALI and also the expenses as well. So I think from most of you doing your tax returns or your investments, etc., I think you're going to be in a reasonable position. If you offload it to your business, then you can offer discount policies as well. Now let's have a look at the compliance approach. 89, is the Commissioner's view that to avoid the application of NALI provisions, parties to these arrangements must deal at arm's length expenditure amounts to be incurred, so on and so forth. Now this is an interesting one. It's particularly important for trustees of large APRA-related regulated super funds to have appropriate internal controls and processes in place to enable trustees to demonstrate they've made reasonable attempts to determine arm's length expenditure amounts when making acquisitions from related parties. Now, this is going to hit I don't know whether they meant to, this is going to hit the industry funds really tough because they use industry fund services. So they are always using related parties in one way, shape or form, or close to parties. So it's going to create a huge headache for them, particularly, for example, if you have a look at CBUS that does a lot of property development. Anyway, there's a whole lot of stuff there. I love that. Whoever's doing this, 1 minute we're talking about in live and now. Nevertheless, the Commissioner is alive to concerns. So it's great. Anyway, for this reason, from the 1st of July 2022, where the ATO applies any compliance resources, because they're not applying compliance until that time, they will only be directed, so this is good, for an SMSF towards ascertaining whether the parties have made a reasonable attempt to determine an arm's length expenditure amount for services provided to the fund, other than services provided by an individual acting either in the capacity as trustee of the fund or as director of a body corporate. So we've got, obviously, we can do it for free if it's us ourselves, and that sort of hangs in the hat when we have a look at the definition of SMSF. We can flick it on to our business, but we need to obviously put in place a process or a policy as to what would normally be the charge around that particular fund. Now, if it's a low-end fund, which I think someone argued before, like it's only a $100,000 fund, work out internally what would you normally charge with that, or what would again, it's a commercial rate. So go on and find out what an eSuper or someone else would do for those. So there's plenty of commercial rates. Remember, it's not necessarily what the commissioner says. We've got to go back to the EM to find out, is there someone doing this commercially, and then find out what that rate is. And then once it's in, then you're sort of locked and loaded. Then we've got obviously that if you've got a discount rate, then just charge whatever the discount rate is. For a large APRA fund toward reviewing support document, anyway, I won't worry about that. So let me have a look at a few questions and we'll go in and doing that. So, So Brad, how do unit trusts owned by SMSF stand in respect of NALI and respect of fees paid by accountants such as ASIC, no accounting fees going to the main group entity? So if we have a look at that, so if that's 1322C, as I said before, with that one, essentially it looks as though, and bearing in mind we've had a look at the ruling, I'll do a bit more of a deep dive because it looks as though in that unit trust issue, and this is where I think they have problems, it's in relation to the units themselves, because the SIS Act doesn't go up into obviously looking under the underlying unit trust. But let me take that on notice, Brad, and come back to you. I think I'm going to have to do a bit of a follow-up on this maybe later on the week. In fact, I've got a session on Thursday on our whole trust suite, including hybrid trust and all that. So I might take that offline, Brad, and I'll come back. I'll embed that into that session there. So Debbie Potts, as we said before, per LCR 2021/2, paragraph 60, in line with this, if we have affirmed all of the discounts, no fee across the board, then the ruling does not capture. That's right, that's correct. So as long as you've got a discount, and make sure it's not a discount you're the only one who can use. Auditors want so Brad Smith, auditors want a real estate property valuation for the market value of the property and also the rent. So I'm presuming there it's a related party, obviously. So if the rent has been stated as $1,000 to $1,100 per square metre, what figure do we choose, or can we select the midpoint? So again, if I go back to remember the EM there, Brad, so it can be difficult to determine exact price, and the Commission obviously doesn't state that because it's embedded in the EM. Exact price, that is not arm's length. An arm's length price may be accepted to fall within a range of commercial prices, for example, loans, blah, blah, blah. So we can have a range there, and then we can choose the mid-range as long as it's okay. How do we choose a figure that will not fall foul of NALI? Or we can get I'd get maybe a couple there anyway to show that it's independent. Mr. Gill, how are you, my good friend? An accounting firm decides on a policy that all partners and former partners in the firm are entitled to discount on the accounting fees charged to partners SMSFs. Does this avoid NALI? Absolutely. Again, just make sure it's a reasonable one. But doesn't it say accounting services not related to tax? So Mark, you're usually pretty smart on that one. Yeah, I think it's actually, you're quite right. I think, let me go through. So that was the NALI. Let me take that on. I'll come back to that one rather than on the fly, because otherwise, Mark, what I'll do is, I think we need to have a little brush up. So I'll do a 10-minute session or 15-minute session on this after our Thursday session. So I'll go and do all our trusts, and then I'll do a 15-minute pop up on all of these questions, because I don't want to be trolling through. Otherwise, I'll be there all the time, and then I don't want to give you non-factual answers. So good question, Mark. Debbie Potts, if the FP for the SMSF does not charge a fee for advice, etc., but receives payment by way of commission or insurances held by the SMSF, is this going to be sufficient as payment, or could this still be seen as discounted? I would have thought that if they're going to get commission or on insurances, that in that instance, that's definitely a payment. It probably will definitely be a market value payment on that one. If we use the LYD solution for upgrade of S&D, given we are using a template, we don't need to charge a fee, and hence no NALI. So that's if you do it personally. That's an interesting one. So a number of our users, like your docs users, if you're not doing it, have got licenses where they use the license through an entity, and then they charge retail back to their trading company, trading trust, which is the smart way of doing things. And likewise, if that was the case, then you'd have to charge whatever the retail fee is for that SMSF deed. I would say that if you're on the Like Docs solution, that's generally that's going to be embedded within the office. So I would then be charging. What I do is probably going following what we said before, Debbie. Probably have a situation that there's a discount for all members of the fund in order to provide compliance for upgrading deeds of the fund. Michael Samu, client managers own residential investment property save fees on using external agent, private lease drafted arm's length market value NALI. So when they're not in property management, I would say that then you're okay. So then you're acting as, remember we looked at it, acting as the individual. So that wouldn't be NALI. For smaller accounting firms with few employees and only the partner having SMSF, what would you need to satisfy the policy with a discount? I think you've just got to be a little bit more careful on that one. Probably go and find out what the normal fee is for that. So just because your clients don't or your employees don't have a SMSF now doesn't mean that it's not going to happen down the track. Following up from the first question about a fair price, I'm a sole person practice will be lodging under my business tax agent number. So again, I'd probably go out. It's an interesting one on that one. I'd probably go out and find out because I know yours was, I think, for under $100,000. Go out into the marketplace because I know there's a few that only charge $300 to $400 for that. So go and look for something and charge that price. If you've outsourced the SMSF accounting, fixed price outsourcing agency, how do you justify charging different rates? Well, you wouldn't be able to do that. So if you've gone to a outsourcing service, it just depends on whether you add on something there. So if you're doing an outsourcing, normally you're going to charge a different fee to the client. You're not just going to do the outsourcing. So there, obviously, if it's internal, it's going to go back to the users in the business. Then the discount might be obviously you're still paying for the outsourcing service, but you might not add any ongoing on that one as well. Good question. Could that clause now allow SMSF to buy computer equipment for the use of trustees to do the accounting work on? Good point. In fact, that's a really good point. I mean, if you remember many years ago, there were people who were going on holidays overseas and saying that they were lectures, etc. So the hard thing you're going to have there, Brad, is you'd have to have a computer or whatever you're doing that is solely for the SMSF. Otherwise, you may well breach the sole purpose test on the other side. Okay. From Mark Rennie, my SMSF has a corporate trustee. It owns 7 apartments in a block of 10. The other 3 are owned by a unit trust related to me. If there are minor maintenance work required, that is cleaning up around the common areas, weeding, mowing the lawn, if my wife and I are both members and directors of the trustee, do these activities and do not charge SMSF or other owners fees for these activities, would that be NALI? I'll take that one on notice, Mark, and I'll get Alicia to do a bit of research on that. In fact, all the questions we're going to get to do research, I'll use my little Alicia to do that one. I would say, having a look at what I've read there, you're the individual, you're doing work to actually maintain the value of those properties. You can't charge for it anyway. So there, as a consequence, I would say that you would be A-okay, but I'll leave that one and we'll come back on that Thursday session. Drew, surely you can take the rate your own business charges for a similar arm's length fund to your own and use that rate as fees you apply for your own? Absolutely. So Drew, that's exactly what the Commissioner is saying is if you've got your, whatever the business charges for you, you can basically charge that, or the business can charge for that fee. Question is then, if you're acting as an individual, can you charge that fee, what a business would charge? And it may well be, you may be able to, but then again, we go back to section 17A, we don't want to breach that, but I'll get Alicia to look at that one. Some great questions here, guys. Can a discounted rate be nil? Absolutely. If across the board, is this still okay? I don't actually do a lot for my accounting tax for my SMSF. I have the staff accountant do it. Can I have the still discount rate? No, well, I think you'd want to see some fee there because I think that's too much of a discount because there still has to be a cost recovery for utilising the services there. But again, remember, it goes back to compliance. We've got a lot of time to work this out until the 1st of July 2022. These things don't need to be answered now. And likewise, remember, we've got to nail this exactly, because if we don't, then all of the income for that year is going to be NALI. So that's why he's giving us that lead up to 30th of June 2022. If you have a company running your tax agent business and you also have a personal tax agent registration which does not do any public accounting lodgements, could you use a personal tax agent registration to lodge the SMSF tax return? I would say yes, that would be okay. Eric Sears, hi Grant. So I charge a market rate for tax via class on my system preparation of accounts and then do a super contribution of the same amount. Absolutely. Eric, you're always smart, but then again, you're a man who drives around in a Harley. So we would expect that of you. So again, what I would do though is, again, make sure there's cash or a promissory note that's charged over rather than an offset there as well. So absolutely, you can do that. In fact, that's a really good point because the Commissioner talks about the contribution in kind, so that if you do full charge, then it will be treated as a contribution. So great pick up there, Eric. I like that one. Alicia, if you can remind me of that one, that's a very smart one. So it's actually bringing the contribution rules from the SIS Act and marrying them with the tax as well. I'm a former partner of accounting practice. The policy of the firm is that it did not charge for tax, accounting, admin costs of partners and former partners. This continues, will this cause a NALI income problem? Chris, I would say not, because they're not really related to you per se. But let me have a think about that one. I think a lot of these issues are coming up. In fact, what I would suggest is a lot of these questions, what I might do is through SMSF, which is the Succession Asset Protection Estate Planning Advisors Association, I might write these down in a submission and then put them off to the Commissioner to get answers for them. I think that'd be a great idea there as well. So where did you get all these documents? Can you share links? So what I'll do is I'll send out this afternoon, this has been recorded. I'll send out the slides. I'll send up all these links. And again, the good thing about this is it's not me saying a lot of this interpretation. I'd like to go to the Commissioner and get a lot of these. Remember, we've got quite a bit of period of time to take it, but I'll get these out and about later on. Let's just go back to the slides and finish it off. So I'm going to be like another couple of minutes on this one. The case study that we've got here, property developer finds a site, decides to acquire the SMSF rather than his development. Is this NALI? Again, potentially, the issue there is that if he normally does it commercially and charges a fee for it, potentially it is NALI, and it's NALI income, NALI capital gain, because it's in relation to the acquisition of a property. So again, we have to find out, does he do it for others for a fee like a finder's fee? Development company provides construction at cost plus 10%. But again, this is more like that LRBA, they've got favourable terms and conditions. So again, I would say that that is definitely NALI, and it's NALI income, NALI capital gain, which is a nasty one. During the development phase, the developers offer $400,000 premium, which they accept as trustees of the fund. NALI or other issues? Well, if they're getting that $400,000, it may well be that you can't say the market value is an issue because they've already got that, but perhaps it could be argued that this construction at cost plus 10% is an issue. But this extra $400,000 that they put on there, it might be an issue because there has been instance where the Commissioner said if you're in that business, that uptick in the market value may be treated as a contribution. So let me say that again. The uptick in market value from your work done, even though it's done at a market value rate, may be treated as a contribution. I'm not quite sure about that one, but I definitely got some guidelines around that one. Trustee SMSF sells the property prior and for $500,000 capital gain in the pension side. Well, again, that's okay, but if it's NALI up here, then that $500,000 is going to be taxed at our marginal tax rates. Okay, lawyer produces BDBN on their internal systems for a normal client fee, and the normal client fee is $2,000. Well, BDBN is actually a member level rather than an SMSF administration level there. So that's not caught up in income of the fund. So that would be A-OK. Accountant provides SMSF administration or firm system and charges a 50% staff discount. Yep, that would be fine. But again, remember, it has to come from the accountant's business. We're just got to be careful in again, the sole purpose test. And we looked at that. So just finalising on Thursday, on Thursday, if you've got time, I'm going to be going through our leading member family protection trusts, our unit trust, our hybrid trust. I'm going to be looking at our SMSF testamentary trust that flows directly from the super fund rather than going through the estate. So there's not caught up necessarily in family provisions claims unless it's in New South Wales. I'm going to look at some of the discretionary trusts. I'll look at all of those. And then what I'll do is I'll tap on the end some of these questions. I'll come back and again, if you guys have got further questions, send them to Alicia, L-E-I-S-H-A, Alicia at lightyeardocs.com.au, Alicia at lightyeardocs.com.au. If you send them to her, I'll look at those questions. And then the ones that I can't resolve or that we're a little bit worried about, why not use the Commissioner's valuable legal resources to find results for us? Again, we'll do that through SMSF, which means there's a good chance it will be going. So again, Alicia at lightyeardocs.com.au, and I'll send the link through. Anyway, we've gone over, I think there's a couple of other questions there. So I've got Debbie Potts. If there's FBT arrangements to do the compliance with a staff member, does that get us out of trouble with the SMSF? With that one, it's probably not a bad idea because if they pay for it fully, it does help with the FBT, and also use the Eric Sears one, which is the use it as a contribution. So I love that one because then it actually embeds. And I think I'm going to get my head around it because this is brand new, so we need to let it mull around. But I want to put in a few extra little clauses in my deed, just to show that we're acting as trustees. So, for example, if I write a new book, am I writing Grant as the individual trustee, or does it have to go through Grant as an individual, or does it have to go through my family trust or Lightyear Docs? So again, the Commissioner is opening up the possibility that the trustee can be doing things for the SMSF. Listen to that again. The Commissioner has opened up the possibility that the trustee can do things, create things for the SMSF. Okay, so that's enough, and Laura's put the webinar link in anyway. So anyway, that's enough for me, and we'll have this linked in. So I'll just bring in my mate Tim and Tony. How did you guys find that one? It's a bit mind-boggling there, isn't it?
Yeah, Grant.
Yeah, I think there's a lot of good stuff out of it, though.
Yeah, look, you've clarified a few things. Look, we've got a few of us in Change Group who are in the process of setting up SMSFs. So we're just going to have a discount policy across the board. And we'll charge, we outsource most of our stuff to Seamless, so everyone will just pay their Seamless fees and that's effectively it. Look, I think you're going to get some via SMSF, which once again, everyone, look, make certain you contact Grant, become a founding member of SMSF because this is why it exists, so we can get some clarification of these things. I reckon we'll keep this in the back of our mind. I'm going to wait to see what you get back from SMSF, how the law settles down. And I think then in the second half of the year, before we get up to 30th of June 2022, in the second half of the year, we'll look to see what we need to do just to tighten up so none of us have NALI or NALI.
I know. So there's plenty of time there, but let's put in a lot of stuff for the Commissioner because then it'll come out as a binding ruling. Mr. Anamoulis, what say you, my friend, my Greek friend in Melbourne, who's not locked down for a change?
Remember we did for the chicken farmer. The chicken farmer, the $10 million refinance facility on that one.
Yeah, I know the related party loan. He did quite.
Yeah, that's right.
Again, it's important to innovate. So the good thing about it is you're coming here, you've done a deep dive on the actual law. So you've seen the law, you've seen the EM, which is up here. You've now seen the Commissioner's interpretation on it. And again, there's nothing in the law, for all the stuff we saw, there's nothing in there that actually talks about general expenses versus acquisition expenses. Ideally, again, Tim, what's happened is there's a void there and the Commissioner's had to fill that void, which I think is actually going to backfire on the industry funds a lot worse, or it's going to create a lot more of a headache for them than is for SMSF. So we're all pretty happy about that one. So it's pretty good.
Look,
Yeah.
I know you're going to put in a submission, but I reckon the industry funds will be tearing their hair out. So they'll be starting to bombard with a few submissions. So let's see what happens.
Yeah, well, bring them over, get those family funds over, release them from the industry funds into that family super fund. Do the right thing for your family.
Yep.
Have you got any webinars coming up, Tim, that you want to do, and how do people get in touch with you?
Well, Grant, thank you very much. We're having Accounting with Dave and Tim coming up on Monday this week. Topic will be coming out on Thursday. I'm just working it through with Dave at the moment. I'm just trying to see if I've got something hot off the press I can talk to you about. Here we go. Monday, we're going to have tips for tricky conversations with clients. You know, those tough conversations that you've got to have, the tricky ones, price increases, how to get a tax strategy approved, when a client wants a second opinion, maybe when you've got to fire a client, all these tricky conversations, we're going to have the solutions for those for you coming up on Monday. So stay tuned. And Grant, I know there's a big From the Trenches live event coming up soon. And I'm doing an estate planning masterclass for accountants. And Grant, obviously, I'm going to get you to be on there with me for an hour, and we'll make certain that we can help accountants. I know everyone here today will have done these things, but we're hoping to have 4,000 or 5,000 accountants on that session. And we're going to try and help most of them to understand, do it for yourselves first before you can roll this out for your clients. Perfect.
Okay, we've all got time pressures. So I've got a 2 o'clocker, but thanks a lot for coming. Sorry for going over time, but it's a very hot issue. It's Grant Abbott, Tim and Tony signing off.
Bye.
Thanks, Grant. Bye.
Bye.
Bye.